Okay, everybody, listen up. This is going to be the best presentation of the day. I promise you that. After this, at 3:10, Alan Gassman and I think Jonathan will be here to talk about asset protection. That's sort of to replace the one speaker who couldn't make it today. So I'm Brian McAvoy. I'm a lawyer with the firm of Retzel and Andrus, and I have the great honor of introducing our next speaker, Barry Flagg. Barry is a native from New Jersey, from the Jersey Shore. He's a proud graduate of Seton Hall University. The day after he graduated, he left for Tampa, and he's never looked back. He started his career in the fiduciary investment business in Tampa area, and over time, he sort of migrated his practice, became an expert in life insurance policies, and became a life insurance advisor. And he built a successful practice by applying the same prudent investor best practices that you'd see in investment advisory world to the life insurance world. He is the founder and actually the inventor of Veralytic. Veralytic is essentially the Morningstar of the life insurance business. He actually invented it as part of he needed it for his practice, and now it is available online to all types of financial advisors by subscription. Most recently, Barry was recognized in a BNA publication as a leading expert in applying established asset management principles to the prudent selection and proper management of life insurance. So please join me in welcoming Barry Flagg. Thank you.
Thank you, Mark. That's great. You're a quick study. So as Mark said, I started my career in the fiduciary investment business, in the pension investment advisory department of a full-service financial planning firm in New Jersey. I'm the son of an actuary. This apple didn't fall too far from that tree. I grew up in a business where my father was putting the words financial and planning together in the same sentence very early on in the 1970s, before the evolution of the financial planning industry that we have today. I just grew up in that environment. And so, as much for that reason as any other, I became the youngest certified financial planner in the history of the College of Financial Planning, and sought to diversify my experience by, after getting my CFP, taking my experience and work in the investment world, going to work as an analyst. So I was an analyst in the pension investment advisory department of this financial planning business. I went to go work as an analyst, which meant a different thing, but as an analyst in a life insurance agency. I half-jokingly say that I pulled my hair out trying to do the most basic, fundamental, easy things, or things that were easy in the investment business, were literally impossible in the insurance business. But I nonetheless, with this experience in the prudent process, was fascinated by the prudent man rule. It just seemed to be a very transparent, reasonable, virtuous way of doing business. When I was an analyst in the investment business, the partners would come back from meetings with clients with pension or profit sharing statements, and I'd use Morningstar and look up the expenses and look up the performance and give them the information to go back to the client, and help advise the client on what they should do, both as a matter of making better investment decisions, but also as a matter of being prudent as a fiduciary of their retirement plan. So I saw great analogies between my work as an analyst in the pension investment advisory business and my early days as an analyst in the life insurance business. I got to Tampa in 1985, young man, all full of himself, graduate of a good business school, youngest CFP. And I'm in downtown, and I'm working in a financial services business in a building with attorneys, and so I'm going to cocktail parties, and I'm thinking, surely to God, I mean, everybody wants to talk about the investment business, but I'm hanging out with tax professionals. So I thought for certain tax professionals would be just dying to talk about life insurance, right? That's what all tax professionals do. They talk about, that's what they do at cocktail parties. They talk about life insurance, or at least that's what I thought. I didn't realize that, and I've learned the reasons why, but I didn't realize that not everybody is going to be as enthusiastic about life insurance as maybe Jonathan Blattmacher was this morning. But I learned the reasons why was because the life insurance industry, in my view, the life insurance industry and the balance of the financial services industry work under two different operating systems. And so Alan Gassman and I got to talking one night at dinner. Sorry, and a reason why, I'm not going to go into these, but a reason why I thought that tax professionals would love to talk about life insurance is because there are unique tax preferences unique to life insurance that are not enjoyed by any other asset type. So again, if you like to talk about financial instruments, and here's one that has 4 tax preferences, I thought tax professionals would be interested in talking about it. But what I came to learn is in these different operating, because the two industries work under two different operating systems, the life insurance is kind of off to the side of most financial and estate plans. It's not subject to the same wealth management practices or prudent investor principles as is every other asset on the client's balance sheet or in their financial plan. And I often call it, and don't get much pushback on this, that it is the last, largest, most neglected asset on clients' balance sheets. It is an asset where few clients and few advisors know what is actually being charged inside the policies, which is certainly different than most other assets on the client's balance sheets. Unlike most assets on the client's balance sheets, few clients and few advisors know what the actual historical performance of invested assets underlying cash values are. They know what the illustrated rate was. They know what the crediting rate or the assumed rate of return on the illustration was, but few actually know what the actual historical performance of invested assets underlying cash values is. And in my experience, and I don't have any data to support this, but in my experience, life insurance has been the worst performing asset relative to clients' expectations over the last 3 decades. Now, that's not to say life insurance, I totally agree with most everything Jonathan Blattmacher said this morning. It's got these unique tax preferences. It can do things that no other financial instrument can do. But in terms of performance relative to client expectations, in the 1980s, clients bought universal life policies that have largely underperformed. In the 1990s, clients bought variable life policies that have largely underperformed. It is, by my observation, one of the worst performing assets relative to clients' expectations. So I asked myself, why is that? I mean, so if it's got all these unique characteristics and it will do things that no other asset will do, why is it not performing the way other assets are performing? So Alan and I got to talking about it and came up with this different operating system principle, if you will, and started talking about, well, what are the characteristics of these two different operating systems? Why don't they work together? And I analogized, well, it's kind of like if you have an Apple device. I have an iPhone and I have a Microsoft Surface. And I love the iPhone because it's got millions of apps. And I love my Microsoft Surface because I think it's a desktop computer in a tablet, but there's no apps for it. And if you try to run an Apple iOS app on the Microsoft Surface, nothing good is going to happen. And so the rules or the programs that you follow need to be consistent with the operating system for you to get what you expect. And so Alan and I talked about this, the top 10 questions that advisors could ask to figure out what operating system their client was in and what what operating system the advisors were working in. So everyone in this room is bound by a consistent code of ethics. In the financial services business, and this is just not the life insurance business, but in the financial services business, there are different codes of ethics. Some have oversight and not policing, peer review. Some have oversight and peer review. Some do not. Some advisors have licenses to work with specific products. Some advisors have licenses to work with all the products. And if you don't have the proper license to work with all the products, legally, you should not even be talking to clients about the products you're not licensed for, which means if you are seeking life insurance advice, that you're not looking for advice on one product, you're looking for advice on what's best for my client. But if you're working with an advisor that is not allowed to talk about some of the products in the marketplace, then you can't possibly be getting the answer to that question. Some advisors are commission only, some advisors are fee only. Neither one is right. In fact, I'll talk more about later that access to both are needed in order to serve clients' best interests. And every single life insurance advisor has conflicts. There is a school of thought that says that if you are a fee-only advisor, you don't have conflicts. And I'm here to say that that's just not correct, and I explain why. There are roughly 3 or 4 fee-only products. There are hundreds of commission products. If you are a fee-only product, your universe, your ability to go serve your client's needs is limited to 3 choices. There is an 80%, I'm stealing some thunder here, but there's an 80% swing between good and bad pricing, and most of that comes in mortality charges. If you don't have the ability to go search for low mortality costs, if you're limited to only 3, those constraints keep you from, or can keep you from serving clients' best interests. So there are always constraints, not saying that they're good or bad, but it's just understand the constraints and talk them through with the advisor and the client. These constraints, the compensation arrangements, and the oversight have to do with the different operating systems. Or they can be characterized really in 2 categories that I call 2 different operating systems. So we'll call one the life insurance industry operating system, and the other I'm going to call the prudent investor or fiduciary industry operating system. So the life insurance industry operating system publishes some guidance, not as much as the balance of the financial service industry, but a piece of guidance that I think is particularly relevant is the life insurance industry, the National Association of Insurance Commissioners, issued a rule or model regulation adopted by the states saying that the illustrations, everybody's worked with an illustration, right? Has anybody not worked with does anybody not know what a life insurance illustration is? Okay, so these illustrations are supposed to be understandable and not misleading. That's what they're supposed to be. But in 2015, many years later, the most recent update to these regs say that the illustrations that you've been using for the past decades have been misleading and hard to understand. So I'm not sure that the life insurance industry, that's one of the differences between the life insurance industry operating system and the operating system that everybody in this room operates by, and that is a client's best interest or a fiduciary industry operating system. So the life insurance industry operating system, the regs start with the product. We've got a product, we want to show how it works. So here are the regs for the life insurance industry operating system. The prudent investor industry operating system starts with the client and what's suitable with the client, what's suitable for the client. And I know I'm going over stuff that's going to be old hat to most everybody in this room, but I want to bring it top of mind so that we can then relate it to the life insurance industry to discuss how to apply to life insurance the operating system that you are already in and are already using. So one of the key duties in serving clients' best interest is examining the information that is likely to bear important on the value or the security of the asset. And the Prudent Investor Act goes on to say that one of those key things, dedicates a section to it, one of those key things is incurring only those costs that are reasonable and appropriate. So what is the cost of a life insurance policy? Is it the premium? Anybody? Is the cost of a life insurance policy the premium? Can it be? I know there are people in the room, Richard, Steve, who know the answer to that question. Is the cost of a life insurance policy the premium? No. Right. Cochran, we have a case that we can point to, Cochran Key Bank, where there were no premiums. Okay, so if there were no premiums, was the insurance free? Certainly not. So there were no premiums. So if the premium is not the cost of a life insurance policy, then what is the cost? And I'll come back to that. So another part of the prudent investor industry operating system is what is the rate of return that's reasonable to expect? How do we find that out? Does it come from the illustration? Maybe. Maybe not. We'll talk more about that. So, speaking of illustrations, I would have to think everybody in this room has been presented with a policy comparison in an effort to determine which policy is better. Steve, did you have a question? No. Which policy is better? Which there is nothing wrong with that, or there has been nothing wrong with that, because that was the only tool that was available. Prior to the advent of universal life, there was no disclosure of underlying costs. So there was no ability to examine some of the things that the Prudent Investor Act says that we should look at. But since the advent of universal life and the adoption of the Prudent Investor Act by most states, and some guidance we're going to talk about, and some litigation we're going to talk about, I urge you not to compare illustrations without going deeper. Goldman Sachs just got sued for $14.2 million, largely because one broker used illustrations to calculate a premium, another broker used illustrations to calculate a premium, and the jury got to pick between the two numbers, and the numbers were $14.2 million different, and the plaintiff was awarded $14.2 million because the jury picked the wrong one as far as Goldman Sachs was concerned. It's just not a reliable method of ascertaining the cost. Ed? I'm sorry? As far as I have been able to find, and I welcome the help of anybody in this room, I've not actually read the case. I've been told that because it was a jury trial and it's up for appeal, the case has not been released. Is that correct? I've never been able to not find a case before, but after talking to attorney after attorney, I cannot find the case. That's the very point. In fact, thank you for the segue, FINRA, the chief regulatory body of the financial services industry, says that comparing hypothetical illustrations is inappropriate unless you are examining underlying costs and investment objectives and investment return, because you risk apples to apples. If you're just looking at the hypothetical, so I said comparing illustrations is not a bad thing. It's only risky if you are looking at the surface numbers rather than getting down below what, for instance, FINRA says is important to look at. Similarly, the Society of Actuaries, so the chief regulatory body of the life insurance, the chief actuarial body of the life insurance industry, commissioned a study concluding that comparing illustrations is fundamentally appropriate, and most recently the OCC published an update to their handbook for unique and hard-to-value assets saying that illustrations are subject to a high degree of fluctuation, and anything that's subject to a high degree of fluctuation is not very reliable for choosing between which one is better in the long term. So I have read Cochran, and I've written on Cochran. I've read French. I've read I'm aware of aspects of the Larry King case. There's a Schneider case in New York, and Vangelos was the former CEO of Merck Chemical Company, and then the Goldman Sachs case. I'm familiar, I've either read or I'm familiar with all these cases, and all of these cases involve the use of comparisons of hypothetical illustrations that got people, that either disappointed beneficiaries or put advisors in harm's way. So I learned from raising my kids that it's really important not to just talk about what not to do. So comparing hypotheticals is probably not a good thing. I don't think it's a good thing. FINRA doesn't think it's a good thing. Society of Actuaries doesn't think it's a good thing. The OCC doesn't think it's a good thing. But it's not a good thing to tell your kids not to just jump on the bed, because if you don't give them something else to do, then they have nothing. There's nowhere to go. So what I would suggest you look at is a group of 17 individuals from virtually every profession who has clients who has life insurance was part of a task force initiated by the Financial Planning Association for CFPs to take established prudent investor principles and apply them to life insurance. It's a 6-step process, 17 dimensions, all of which can serve as a checklist for those things that you could be asking your client or the advisors that your clients are working with to ascertain which operating system are they working in. Are they working in the life insurance industry operating system, or are they working in the prudent investor industry operating system, the client's best interest operating system? So Alan talked this morning, Alan talked this morning in his presentation a bit about term insurance. That term insurance is oftentimes not presented. At the risk of stating what everybody I'm sure in the room already knows, but often goes unsaid, the commissions payable on permanent insurance products are generally higher than that payable on term insurance products, so term insurance products oftentimes get overlooked, which is what Alan said. However, it's really important to understand the needed duration of coverage before even getting into a conversation about product type. Because there are different types of term insurance. There is what I call fixed duration term insurance. So there's annually renewable term insurance, which Jonathan talked about this morning. There's 10-year term, there's 20-year term, there's 30-year term, there's some term that's in between all of those things. But there's also kind of a marketplace term for flexible duration term, which is technically not term insurance at all, but it looks, smells, and tastes like term insurance, and it can go to age 100 or age 120. Rule of thumb, if the needed duration of coverage is less than life expectancy, then term insurance is almost always, if not always, less expensive. And there's a reason for that. Because insurance companies won't issue the fixed duration term insurance any longer than life expectancy. That means that on a fixed duration term insurance policy, 10-year, 20-year, or 30-year term insurance policy, the insurance company is only paying half of the claims that they're insured for, that they had previously insured. Does that make sense? Because life expectancy is right in the middle of the number of people who die and the number of people who live past life expectancy. Term insurance is only issued up to this part, so they're only paying claims on half of the total pool. So they only have to collect premiums to pay claims on half the total amount. Therefore, term insurance is rule of thumb, term insurance is almost always less expensive if the need for coverage is less than life expectancy. However, if needs change, it is important to consider convertibility. Some term products allow conversion to a permanent solution all the way up to the end of the term. Some don't allow it at all. Some allow it in the middle. So in this changing world that we live in, it is important to consider, all right, I think our current plan is that we can get rid of this estate tax over the next 20 years. So we're going to get 20-year term. But if the estate tax exemption goes from 10 to 2, game's changed, and we may need to do something different. So the inverse of my earlier rule of thumb, if the duration of coverage is longer than life expectancy, and both Jonathan and Alan talked about term insurance, but rule of thumb, if the duration of coverage is longer than life expectancy, permanent insurance is almost always, if not always, less expensive than term insurance. I want to come back to something in a little bit, but The one, and Alan did talk about in his presentation, if you didn't sit in his presentation, get his materials, he included a nice matrix for the defining characteristics of the various life insurance products: whole life, universal life, guaranteed universal equity, universal life. A couple of points I want to make here. The 4 products listed on the screens right now are all what are called traditional insurance products. Traditional doesn't mean anything necessarily to this audience, but they're called traditional insurance products, and traditional insurance products are backed, or the cash values are invested in the insurance company's general account. The insurance company's general account, by regulation, has to invest, as a practical matter, in high-grade bonds and government-backed mortgages. So I personally have seen illustrations from the same insurance company for different product types that have had considerably different rates of return in their hypothetical projections. Now, if both products for the same insurance company have to be invested in the same asset classes, and for the same insurance company have to be invested in the same actual general account, how can the interest rates be so different? How can the expected rate of return be 200, 300 basis points different? I'll come back to that. Another interesting thing, the word equity, Alan commented that there are some reasons to be cautious with equity indexed universal life, with indexed universal life or index products. That is not to say that they are bad or that they don't have their place. But as an example, when the products were first introduced, they were referred to as equity indexed universal life. There was an amendment to Dodd-Frank called the Harkin Amendment. There was some activity by the SEC and or FINRA to bring equity indexed universal life products in under their jurisdiction, which would have brought them into the prudent investor operating system, which would have brought them under the FINRA rule that I mentioned before, which would have brought them into greater oversight. But Senator Harkin added to the Dodd-Frank bill an amendment saying that equity indexed universal life products were not securities, just by congressional declaration. And they dropped the word equity. Equity index, but it is important to remember when you're looking at, and I'm going to come back to this in a couple of questions. It is important to remember that when you're looking at an equity indexed universal life illustration, the cash values of that product have to be invested by regulation, as a practical matter, in high-grade bonds and government-backed mortgages. And then there's variable life, where cash values can be, the invested assets underlying cash values can be invested in whatever asset allocation is appropriate for the client. Private placement variable life, Jonathan talked about this morning. And then there's an increasing number of hybrids, where there's a product that's variable, but it's also got an index in it, or it's a whole life product that has added, that is now based on an index instead of a dividend. So the life insurance business is getting more confusing from the life insurance industry operating system perspective. And I hope to give us some basic tenets to think about life insurance to make it a little more fiduciary friendly and less confusing. So if the client's coverage, if the needed coverage duration is longer than life expectancy, and we have all these different product types, how do we choose? Well, modern portfolio theory, several institutions have done studies that under modern portfolio theory, 80 to 90% of the total return is driven by the asset allocation. So if 80 to 90% of the total return is driven by asset allocation, and traditional products are required by regulation to invest in high-grade bonds and government-backed mortgages, then we know what the rates of return for the high-grade bond and government-backed mortgage asset classes are, and we know what the rate of return would be for a diversified portfolio. So the product type and the rate of return that's reasonable to expect, or at least a tool to help ascertain that is the acronym RATE, which stands for the risk tolerance of the client, the asset allocation that corresponds to that risk tolerance, the time horizon, and then what does the client expect in the way of outcome, just as kind of a double check. So if we're going to pay premiums into a permanent product, some are guaranteed, some aren't. If we're going to pay premiums into a current product, under what circumstances? So in a term insurance product, the premiums are guaranteed. In some permanent insurance products, the premiums are guaranteed. If they're not guaranteed, under what circumstances can or should the premiums change? Well, to understand when or by how much a premium can change, you have to understand how the premium is calculated in the first place. And the premium or the performance of any life insurance policy is a function of three and only these three things. And so if you're looking at an illustration and you want to get deeper than the hypothetical premium calculation for the reasons we've already discussed, you want to ask about these three things. These three things are generally available for every universal life policy available in the marketplace. Not available for whole life from the carrier, but it is available through Veralytic research. In other words, the premium or the performance of any life insurance policy is a function of this formula. If there's one thing that you take away, two things that you take away from this session today, one would be that acronym RATE, which would help match up client circumstances with the right product and the right rate of return expectations. And the other would be this formula for the getting beneath the hypothetical premium or the hypothetical cash values for understanding what are the factors that contribute to or that could change on policy pricing or performance. So the circumstances that under which a premium can change or should change, and I'll come back to the reason why I say that differently, is if actual earnings are less than expected, which has happened to a lot of people. Most recently, costs could be more than expected. A number of insurance companies, about a half a dozen big name insurance companies, have been sued within the last 6 months because they have increased cost of insurance charges. And another factor where a premium can or should change is changes in life expectancy. The duration of the premium is a function of those, the COI plus expenses minus interest, over the duration of coverage. And so somebody may say, you know, I'm in my 50s, I'm really healthy, and so I want to make sure that this insurance, that there's no way that I can outlive this insurance. So they calculate a premium that covers them forever, to age 121. But they're in their 70s, they've had some health mishaps, they've had change in their risk profile. There is no reason to pay a premium that guarantees coverage or provides for covers all costs for coverage out to age 121. So there are times where the premium should change, and the carrier won't necessarily notify you. The flip side of that is if a policy is underfunded so a policy could be underfunded because earnings are less than expected or costs could be more than expected, the insurance companies will not notify clients that a premium call is due unless it's whole life. If it's whole life, they will send you a premium notice. If it's universal life, they won't tell you that the premium should change until the policy is going to lapse. So there are times where the premium will change on you, and there are times where the premium should change, and that requires some oversight. Managing the changes, or properly setting expectations and managing the changes, I would avoid comparing hypothetical illustrations. Remember, premiums are not quotes unless the premium is guaranteed. Confirm costs and earnings are consistent with actual historical performance, and if either you or an advisor you're working with is a member of the Society of Financial Services Professionals, they have a Monte Carlo tool where the tool can calculate the probability of a given premium actually accomplishing the desired result. So the insurance company illustration system may say that at a 10% rate of return, the premium is $10,000. But because of fluctuations, to get a 10% rate of return, our asset allocation is going to have to include a large equity component. A large equity component means the cash values are going to go up and down over time. As the cash values go down, the insurance company is going to take their cost of insurance charges out, regardless of whether the market's up or down, and it's going to adversely affect the cash values, meaning the cash values are no longer going to be sufficient to cover all the charges. So the Monte Carlo system calculates, and it's a free tool if you are a member of the Society of Financial Services Professionals or working with a member of the Society of Financial Services Professionals. It's a free tool that helps calculate the probability of a given premium actually achieving the desired result at a given rate of return. So we said there are three things that determine over time the pricing or the performance of a policy. The costs, the cost of insurance charges, the expenses, and the rate of return that's reasonable to expect. So we've already talked about the premium is not the cost. The cost is what's charged inside the policy. And whether or not the insurance company discloses the discrete elements of pricing or not, all insurance policies, the cost of all insurance policies considers the cost of the insurance charges, which, as I alluded to earlier, are the biggest expense. There is an 80% swing between low COIs and high COIs. Expenses that the carrier collects for actuarial, design, underwriting, administration, distribution, and premium loads that the carrier collects for state premium taxes, DAC taxes, and sales loads. And so where Veralytic can be useful is in understanding is what is being charged inside. So that if I can't compare premiums, because premiums are hypothetical and FINRA says it's not a good idea and the Society of Actuaries says it's not a good idea and the OCC says it's not a good idea, if we really can't compare premiums, and if premiums aren't really the cost, how do we compare costs? Well, the way we do it, the way Veralytic does it, is measures the average cost of insurance charge, the average expense, and the average premium load for all the thousands and thousands of policies in our database and calculates an average and a standard deviation. So that's how we know that there is an 80% swing between good and bad pricing. And by the way, that range, that variance, is consistent with a study commissioned by Tillinghast Towers Perrin, big actuarial firm, and a third-party administrator of trust-owned life insurance, both of which were referenced in Trust Estates magazine some years ago. Yes? Sure. It's too quiet in here. Please do.
How do you deal with the fact that one carrier considers the client at one risk class and then another carrier? A lot of times that can be price differences. You get standard from one carrier, preferred from another. But let's say that the preferred carrier on your equal risk class measurement is actually more expensive on the underlying expenses.
Correct.
So how do you compare apples to oranges there?
Two-step process. So every rule of thumb is wrong, right? But rules of thumb are useful nonetheless. So rule of thumb, the difference between standard and preferred is about 8%. The difference between, Alan referenced this, he says I have a word for bad pricing and a word for good pricing. And he said WART. It actually stands for Worst Available Rates and Terms. It's an acronym. So the variance between worst available rates and terms and best available rates and terms is 80%. So if you get a preferred rate offer from a carrier who's among worst available rates and terms, you can get a substandard rate offer from somebody who's in the best available rates and terms category, and you'd be better off. So it's a two-step process. First, find out which carriers have rates on file with the State Department of Insurance that are among best available rates and terms. Step one. Step two, do the underwriting process. If if the provider of number one best available rates and terms can't deliver the health risk class that you expect, go to number 2, go to number 3, go to number 4. But you start with the widest variance in costs first, and then do the underwriting to fine tune it. Did that make sense? So, and then Alan provided an example in his presentation that the cost savings. I analogize that my job or what Veralytic helps do is find money. You find money for clients. If you find money for clients, it's the client who gets to decide what they want to do with the money. The client and their advisor get to decide to do with that money. And Alan used an example, real life example, where the client used the money to reduce premiums. But the client could use the money to keep paying the same premium and increase the death benefits. The client could use the money to reduce the risk. Maybe they're in an asset allocation that was appropriate when they were 50, but they're a little more conservative now. The time horizon is getting shorter, so they want to take a little less risk. And so we can take some of the money that one insurance company was overcharging and another insurance company would charge less, and take those savings and put them into cash value, so we don't have to take as much risk on our asset allocation, or extend the duration of coverage. I can't remember whether it was Alan or Jonathan talked about this morning, the insured who got to age 100 and was told that he had to take the money at age 100 even though he was still alive. In that case, probably it wasn't a very well priced policy if he had actually paid more in premium than he was getting back in death benefit. But that could be a bad tax consequence, that at age 100, if you got $1 million policy, you're going to get the $1 million under old policy forms. And that $1 million could be, to the extent of gain, will be taxable at ordinary income rates. Bad tax result. If you identify a policy has excessive charging in it, and the insured can qualify for at least the same health risk class and reduce those cost savings could be essentially thrown into cash value to extend the coverage duration beyond age 100. So I said I'd come back to, modern portfolio theory says asset allocation is the largest driver of the rate of return, the actual rate of return that's reasonable to expect. I don't care what the illustration says. So if you think about it I was having lunch yesterday with several trust officers, and we were talking about this topic, and I said, so if I asked you what rate of return is reasonable to expect from a universal life policy? No idea. What rate of return is reasonable to expect from a whole life policy? No idea. What rate of return is reasonable to expect from an equity indexed universal life policy? No idea. Although I did, when I said what rate of return is reasonable to expect from a variable life policy, they said, well, that would depend on the asset allocation. And I said, well, actually, that's the answer for all of them. It's just that for all the others, you know what the asset allocation is because the asset allocation is set by regulation and risk-adjusted risk ratios, carrier risk ratios. So by my view of the world, using historical data for the asset classes into which the policies either are required to be invested or can be invested, the chart on the screen shows the product types that would likely be suitable for a given client situation and the rate of return that is reasonable to expect. I will not dispute that there are providers in the marketplace, as we sit here today, who are running illustrations for a whole life policy whose invested assets, underlying cash values, are required to be invested in high-grade bonds and government-backed mortgages, and they're assuming a 7% net rate of return. 5 minutes. Something else that's too convoluted to go into here, time doesn't allow, but it is also important when you're trying to understand the rate of return reflected in a particular product's illustration. Some insurance companies will show the gross rate of return. Some insurance companies will show the net rate of return. Some insurance companies will show something, it'll be displayed as the net rate of return, but it's actually the net rate of return. Just when you're looking at VUL illustrations, it is very important to understand what is being deducted from the rate of return that deducts no fees, the rate of return after the deduction of investment fees, and the rate of return after deduction of insurance fees. 3 levels of fees in insurance products. So we've discussed the rate of return reasonable to expect on invested assets underlying cash values is germane to the pricing and the premiums and the cash value accumulations. But life insurance is being increasingly promoted as an asset class or an alternative investment, an uncorrelated internal investment. And so there's a rate of return on the death benefit, right? Well, it's important so the IRR at death is a function of, at the risk of stating the obvious, when the client dies. And when that is the client's life expectancy. The rate of return, from an actual case that Alan and I worked on together, the rate of return shown on the illustration at life expectancy was considerably less than if you were to use a different and arguably more appropriate mortality table for somebody who was in the high net worth class, and then if you made or for the affluent class, and if you made adjustments for the high net worth class, the rate of return was again substantially different. So for a proposal that suggested a life insurance policy would be a neat alternative, an attractive alternative to muni bonds because it would generate a 6% rate IRR, the rate of return that was reasonable to expect in this particular client situation was almost 200 basis points less, which would be a big swing on a fixed income security. In addition, the yield curve, if you will, on life insurance is inverted. Ordinarily, the longer you hold an investment, the more you are paid for the risk that something could go wrong during that holding period. With life insurance, the longer you hold it, as you can see on the chart, the lower the rate of the return gets. So those are just 2 things to watch out for, be careful of. Yeah. Yes. And by the way, I was asked to review this by trustees of a trust, applying the West Point draft that I mentioned and fiduciary principles. And so I was not commenting on whether that's good or bad, and I had no input into the selection of the product. So I don't know if that was a good or bad return relative to other products. It's tax-free, but what was not disclosed was the risks that I just mentioned. So clients, I think, too often don't think about the liquidity restrictions on the policies, or actually don't think about an exit strategy. Again, we live in a changing world, so what is our exit strategy? And it could be turning in the policy. If it is turning in the policy, then restrictions on cash values are not a good thing unless we're getting something for it. If we've got restrictions on cash values, then, and because of those restrictions, we get lower cost of insurance charges, that might be an acceptable trade-off. But the important thing to remember from this slide is, yes, life insurance policies have restrictions on equity, but there can be trade-offs, there can be reasons why it's worthwhile. A product without restrictions on equity, but higher costs, might not be worth it. So it's not just liquidity, it is to consider what are the trade-offs that I'm getting for liquidity, or what are the benefits that I'm getting for giving up liquidity. And then lastly, I'm going to accelerate here. Ratings, I think ratings are certainly important. The industry, I think, has part of the life insurance industry operating system is, ratings are maybe a paramount consideration. And they are important, but they're one of 5. Financial strength of claims paying ability is important, costs are important, the stability of pricing is important, access to cash value is important, and actual historical performance of invested assets underlying cash values are important. The ratings are perhaps most useful, even more useful than making sure that the carrier is going to be able to pay the claim, maybe even more useful as a leading indicator for cost increases. There is some correlation between carriers' ratings downgrades and later announcing cost increases. So while I'm not aware of any death benefit that has ever not been paid when a carrier failed, ratings are important because if you watch the change in the ratings, you might get a heads up that the carrier could be increasing costs. So in your app or your download, you should have the 10 questions from the BNA article that Alan wrote that was kind of the impetus behind all this. I mentioned the Cochran case. I wrote an article for Trust and Estates. I think this is as good an example as there is for illustrating the differences between the life insurance industry operating system that got the Cochran that resulted in the Cochran beneficiaries losing between $2 and $4 million. The recent lawsuit against Goldman Sachs, I think, is very instructive. And you should have the best practice standards. And if you don't, I've got some hard copies at my table. You're welcome to grab those or email me. Lastly, Alan also encouraged or mentioned that I'm happy to provide. The good news of having a patent is the government grants me a monopoly for 20 years. The bad news about having a patent is nobody knows what it is because it didn't exist. So I'm happy to let you all learn what it is by providing you with a complimentary report on a policy of your choosing. If any of that was interesting to you, I write a fair amount. I talk too much, some say. You can follow me on LinkedIn. I don't do as much on Twitter or Facebook, but when I publish something, it'll be announced on LinkedIn, and you can download it there if you like. Any questions?